is what we might open. But specific stocks and specific ideas for you to look at, that's what we are giving you. And the first one on my list is Neogen Chemicals, based on their numbers. It's a thumbs up from our side, just because the numbers have been strong. Revenue growth led by volume growth and contribution from Bull Eye Chem. Remember, they acquired this company in May of 2023. The EBITDA growth is led by operational efficiencies and lower employee costs. They've seen a PAT growth due to better operating performance and a favorable base in Q3 of FY24. So what are the numbers? Revenues rose 22.5% at 201 crores. EBITDA rose nearly 71% at 34.6 crores versus 20.3 crores. And the big hike in margins is what will give comfort, from 12.3% to 17.2%. Profits also have gone up substantially from 1 crore to 10 crores. So Neogen Chemicals is something that you can track this morning. The stock was already 5% up in Saturday's trade. Anant Raj, I thought, was interesting just because of the way that company, that counter has really moved. So Anant Raj is the next one in my list. Also a thumbs up just based on the numbers. So let me take you through the numbers first. About 36% up on revenues at 535 crores. Their EBITDA was up about 48% at 134 crores. Margins have gone up as well from 23% to 25%. And net profit grew about 53% for Anant Raj. Remember, that stock has been in focus all of last week. It was down 17% in the last 5 days because of DeepSeek and the emergence of the Chinese AI startup. There was some recovery after a clarification from Anant Raj where they said that AI applications move closer to the end user demand will rise, so they're not too worried. They believe demand for data centers will rise versus contrary expectations, and they don't expect technological advancements related to AI to impact performance. Remember, they're in the data center business, and the whole DeepSeek phenomenon was a pain point for them. Shares have already closed 7% up on Saturday's trading session, but the numbers have been decent, so keep an eye on that. Adani Power is the third one I'm looking at. Basis this Jefferies note this morning on Adani Power. They've initiated a buy with a target price of 660 rupees, nearly a 30% upside. They've said that this is India's second largest thermal power generation company after NTPC. It's a pure thermal play, and they estimate 1.7 times rise in capacity between FY25 and FY30. So in the next 5 years, basically. Land requirements and financing plans are in place. Night peak deficit provides scope for merchant upside, says Jefferies, and they see their leverage to reduce to 0.6, their balance sheet leverage to reduce to 0.6 times by 2030 versus 1.2 times. So that means to halve by 2030. They expect a 2.2 time rise in EBITDA as well by FY30 estimates. The close coordination with BHEL for equipment delivery and in-house EPC are also ensuring capex is on schedule. So that's why Adani Power, one of them. Although overall, I think capex-led stocks are going to be under pressure. There's an interesting, when you listen into the full interview, and I think we can play it a little earlier as well. There's an interesting question that we asked Finance Minister, that what about this capex number? The street's not too happy. Should listen into her answer where she says, you think 10% on this base is less? So we'll play that out for you as well. But yeah, those are my first three stocks.
No, that struck me as well. It's not a pivot, she says, to consumption. We are very much focused on capex. Very clear statement by the Finance Minister. I've picked one stock on earnings and a couple more on the other updates that you've got. Aarti Industries stood out to me. It is a miss on a couple of fronts on the earnings. The revenue, of course, in line. It's up about 6% or so. The estimate had pegged it at 1,729 crore rupees. It's come in above that. But the problem has emerged in the margins, which were below estimates at 12.6%. Margin pegged it at 13.3%. The net profit has declined by as much as 63%. What's gone on in the quarter? You have agrochemicals, which continued to be soft for this company, and you have pricing pressure that persisted across various product chains, again, for this company. The finance costs were higher, and the finance costs and PAT were impacted by mark-to-market losses. That's something to bear in mind in the results. Expect there to be a little bit of an impact, particularly because it was up and about and has been over the past few trading sessions. Oil marketing companies as a group should be in focus. They reacted negatively on budget day to the lower petroleum subsidy than was expected. there could be a possibility of cabinet approval for a higher subsidy. So in that case, that would be a huge positive. For now, though, with the information we currently have, it is a negative. And also the possibility of a rise in crude oil prices based on what we've been speaking about all morning. Tariffs going up in various parts of the globe, US levying tariffs, other countries levying tariffs on the US, all of that will have a bearing on crude oil prices, and that is negative. A higher crude oil price is negative. Eicher Motors, one of the automotive companies that came out with volume numbers for the month of January, very strong numbers, 20% growth versus the comparable period, and this is year on year. It's up 20% to 91,132. The estimation was for 87,000, so it's coming substantially higher than expected. There's also a Jefferies note which talks about the fact that a lot of these companies have registered strong growth in the month of January. Their big picks and buys are M&M, TVS and Eicher.
Okay. And I'm going to take on the chemical flavor, by the way. So Neogen is one, UPL is the other one, agrochemicals we spoke about, looking very attractive. So Investec has a note on UPL. They have upgraded the stock to a buy from a sell. They have hiked the target price to 700 from 450. I think Equirius tracks this very closely. They have put out a positive note too. They say the upgrade, Investec is saying the upgrade is on improving outlook and supportive valuation. They say to achieve the guidance on the back of recovery in global macro demand and focus on operational efficiency. And UPL should also be able to bring down its overall debt levels in FY25. So watch out for this one. Incidentally, by the way, Vinati Organics, good performance. US subsidiary could do well. Thirumalai Chemicals has some US exposure, could do well. 15% up in Saturday's session or Friday's session. If I'm 12.5%, could re-rate further. So watch out for the chemical names. Very quickly, two other names that I do want to mark. ITC, big budget beneficiary, because of these reasons. So Jefferies maintains a buy with a target price of 550. Jefferies says ITC comes out as a winner with tobacco taxes unchanged. Morgan Stanley calls it a re-rating play showing sustainable growth. Their target is 554. Won't be surprised if there's some uptick on ITC today. Last but not the least on my radar, L&T, amidst all this capex pullback conversation, and which is rightfully so, L&T, just want to mark, corrected a bit. It has limited exposure to roads, rail and defense. It was just 2.5% of inflows in FY21 to 24. The market share in the high growth metro and transmission are at 23 and 20%. And a further uptick in airports and nuclear, which is about a 50% market share for L&T, is a positive. This is as per a note from BNP Paribas. So watch out for L&T. Maybe in a bad day too, might see some bit of reversal.
I find the pick of L&T interesting because everyone has been completely negative on the capex flow.
But Priyankar Biswas is saying this, CLSA's conviction list has L&T. Parag Thakkar was saying L&T. So I think
the numbers
order book looks
good.
Order book looks good. Yeah, but the problem is order inflows in the future for all defense names, right? Order book looks good, but order inflows. But L&T might be an outlier.
Yeah.